Let's talk more about the market outlook now with Joseph Little. He's Global Chief Strategist at HSBC Global Asset Management. Joseph, it's good to see you. Now, there has been a lot made of the so-called reflation trade this year, of course, as people look ahead to opening up in the latter half of the year in particular. And it seems like we've had a big rally thus far, right, in stocks. So as you said in your note to us this morning, you sort of posed the question of whether the reflation trade has already played out. Has it, do you think?
Well, I think, Julie, you're right. And thanks for having me on the show again. But I think you're right. This is the key question for investors at this juncture. We've seen a very strong phase of what I call fast markets, a strong rally last 6 months in risk asset classes across the board. And what that means in practical terms for investors is that a lot more is now discounted. The story around recovery, around macroeconomic improvement, around the vaccines is now at this point well known to investors and to other market participants. And that poses the question of what could happen to markets next. My suspicion is that we're at a point now where as more is discounted, it becomes harder and harder for the news to really support the market further and further. And that creates what I call a hypersensitivity. It means that markets are rather vulnerable if the news flow becomes a little bit more difficult, if the news flow begins to disappoint. I'd still be positive as we look out over a 6-month view, but it could mean that after the run that we've seen, we're in line for a phase of maybe a bit more consolidation, maybe the facts about the macroeconomy and the virus trends need to catch up a little bit with how the market has been performing over the last 6 months.
And Joseph, when you think about some of those potential negative catalysts, is it fiscal authorities maybe coming out with a disappointing either offer, guidance, however we want to frame that? Is it central banks having a misstep? Is it a fourth spring rise in cases? How do you kind of think about those various possibilities here for upsetting markets?
Well, it's a great question. So, I mean, the good news so far is that what we're seeing for Western economies, for developed markets in the West, is that winter surge of cases is beginning to look a little bit better. We seem to be past the worst, as your report earlier suggested. So I think the big challenge really is around growth disappointment relative to what economists, what analysts, what investors are currently expecting. And the most obvious way that plays out is through some of these new strains, these mutations to the virus, being a little bit more resilient or resistant to the vaccine. I think that's a potential challenge in terms of how it could impact sentiment and almost require an extension of some of these stringent measures. Now, it's not so much my base case. My feeling overall is that we're still in a phase of gradual recovery, what I call the restoration economy. But I don't think it's rapid in terms of how it plays out. And as I say, I think this risk around some news potentially disappointing, rather elevated expectations at this point in time is a real challenge for the market in particular. If we look across the other risk factors, I take your point completely that policy is such an important factor. But I think the message that we get from the Fed, from European Central Bank, from other central banks is of continued support and stimulus. I think the message that we see coming through clearly from fiscal authorities is that there is an intention to continue to support the recovery with policy support on the fiscal side, at least in developed markets. So it could be that we see some emerging markets begin to retrench back the policy supports a little bit earlier. But I think in developed markets, the policy very much will be there. And really, as much as anything, the challenge to markets comes related to how expectations have already moved ahead and whether or not the incoming data can improve as quickly and as significantly as some parts of the market seem to assume or want it to. And of course, we hope it does, but we need to be realistic about the shape of the recovery here. As I say, the restoration economy, as I've called it, is not a real rapid recovery story. It's going to be a case of some stops and then some starts before we move into a stronger phase of cyclical recovery, probably in the second half of the year.
Just based on some of those risks, do you think we're headed for a February correction?
Well, I'd probably frame it as more of a consolidation phase at this point in time. But I think there are some challenges out there. As I said, I don't think it takes too much in terms of the incoming news to disappoint market expectations and what investors are looking for. So we need to stay very alert. The data on earnings, the data on corporate fundamentals, the data on macro trends and growth is going to be really important. And I think investors just need to sort of stay very vigilant to some of these risks. Of course, it's risky being out of the market as well. So we want to still be invested, focused on global equities, focused on some of the opportunities we see in Asian investments. But it's really important at this point to be very vigilant and alert to how the situation is evolving and to some of the news flow that we're seeing, particularly on these new virus strains, particularly on how resistant they might be to the current vaccine technologies. Because I think there is just a danger that some small disappointments could create a bit of anxiety and tension in global markets.
So, Joseph, just quickly then, given the changing nature of the situation, what would be your highest conviction allocation right now that might have some staying power no matter what else happens?
Yeah, staying power is a great way of putting it, Julie. That's a really good phrase. So I think the way I would call it in financial jargon is sort of risk-adjusted returns. But the staying power is maybe a better, certainly more fun way of putting it. I would probably be focused on some of the areas of more risky fixed income. So asset classes in Asia, in the credit space, high yield investment bonds in Asia, some of the Asian government bond markets, Chinese government bonds, for example. These are asset classes where investors can pick up a reasonable amount of additional yield, and where some of the fundamentals, the corporate fundamentals, the country fundamentals look reasonably robust, even resilient. So we talk about some of those North Asian economies, parts of industrial Asia being fortress economies because of their ability to withstand some of the economic and health crisis challenges in a way that seems to be more resilient than other parts of the global economy. And that might be the part of the system to focus on. I think if we want something a bit more in the equity space, maybe parts of South Asia, which can benefit from a bit of a catch-up story as and when that recovery plays out. But as I say, there are some challenges around that. So for the time being, I would be focused on some of these fixed income asset classes in the emerging markets, particularly in the Asia space.
Gotcha. All right. Joseph Little, good to see you. Thank you so much. Global Chief Strategist at HSBC Global Asset Management. Appreciate it.